Hello, Steve Lentz here with OptionVue Systems and Discover Options Mentoring. I'd like to discuss with you decision-making with OptionVue software. Decision-making with OptionVue software. Let's bring up OptionVue here. And we begin with our quotes display, and you need to begin with an underlying asset or a group of assets that you're interested in. In particular, in this instance, I have a few stocks listed here from Investors Business Daily's Top 50. Comes out every Wednesday or so, and so I just threw in a few symbols, and let's assume that we're bullish on these items here. Now, you could use value line, you could use another scanning type of service that you have. In OptionVue, we could bring in some that have just high implied volatilities, but the point is you need to begin with a group that you're interested in. And so let's go to Pioneer. I'm going to bring up the matrix for Pioneer. And let's start with a strategy called naked put writing, naked puts. And so what we're looking at here are the calls on the top, the puts on the bottom, and then reading left to right, we have the various months, Nov, Dec, and Jan. Each option has a market price, an implied volatility, and then the trade area. Now, the trade area is where we're going to propose a certain type of trade. In this case, let's propose selling this 180 put at $1.59. That brings in $159, of course. And when we analyze this, we get what we call a graphic analysis screen. Let me drag this up here. Very good. Now, the way you read this is that you have an x-axis at the bottom and a y-axis on the left side there, and as the market moves up, or in this case, as Pioneer moves up, we move to the right. As it moves down, we move to the left. And then we have a zero break-even line. Anything above the zero break-even line is gain, underneath it is loss. The expiration line is very easy to understand and program. It means that at expiration, you could see that we would make $159 so long as the stock remains above that strike that we sold it at 180 right there. You see that? Now, between now and then, we have today plus zero. That's today's line. If today this thing were to go to 181, we would lose $266 on that trade. You see that? If this happened 5 days out, let me click that line, we would lose 110. However, of course, if the stock went up, this position would gain. You could see that 131, 147, etc., all the way up. So we have multiple time frames here, and at expiration is the solid blue line in that case. All right, let's compare that naked put position to a different one. Let's say that we wanted to go further. Let's just go right to, let's go up to the 185 and compare it to that one. Go a little bit closer to where the stock price currently is at almost 189. Okay, let's analyze that. We get a similar looking graph, but if we go to the yellow arrow up here, we can flip-flop between the two and then even click superimpose. And as I said earlier, this is all about comparing positions. This is all about comparing positions one to another and making the correct decision. Okay, which trade complies with your market outlook? All right, how certain are you this is going to go up? And if it does go down, how much are you willing to lose? And you can kind of compare these. Let's go to just two lines. If today it went down, well, that first trade we looked at would certainly lose less money if it went to 181. We'd lose 266. The second trade, we would lose 405. So that should help you in your decision making. Of course, if it works out and it goes up, you would make 159 versus 305. Now, we could compare these two positions in terms of yield as well. Yield on the amount required to put the trade on. And here we've changed it a little bit. 9% on the second trade versus 6% on the first. See that? Now, we can also, of course, change the dates a little bit. Let me change the maximum projected date from expiration. I could back this off to say T plus 5 days in the future, even cut it to 1 day, and I can then go down in the future and go all the way to expiration. Nope, we're good there. Okay, and there you go. I'm just using my bracket keys there to advance the date back and forth. Okay, now let's look at another strategy called credit spreads. You may not want to do naked put writing. Instead, you could just do credit spreads instead. Let's do a 5-lot spread with a short strike at 185. Let's compare that. Very good, and there we go. We have the credit spread. The yields are much better because the amount required is so much less. All right, we could go to let's go to profit and loss. There you go. That's the amount of money we're making on the trade if it stays the same or goes up. Or we can go back to yield. All right, now let's go change this to a different strike. Let's go ahead and go further out of the money. Let's do let's just go further out of the money here and do a 10-lot further out. Bring it in 580. Let's analyze. And there we go. We're making less yield there. Okay, profit and loss 580. Yield is only 6%. If I go back to the other credit spread, the green one, we have 29%. I could superimpose. And again, this comes down to decision making. Which spread would comply best with your risk-reward tolerance on the downside? If your stop is at 181 or 187, you can see what the yields you would have on the downside. Now, if you go to the other trade and you go to there we go. Here, where were we? We were over there. This is today's line. Okay. You can see that we're going to lose a lot less money with that farther out of the money spread than we would be with the one that's kind of closer to the fire, so to speak. So again, it's about comparing positions and making it relevant to where your particular stop is and your risk tolerance. All right, what's another trade we could try? Let's do debit spreads. Let's do debit spreads. Let me clear these out using that little eraser button. And we could just go to the calls and put in, say, a long 10, lot there. Short, this is a debit spread here. I know. Yeah, let's compare this one. We're just going to buy that at the money option. Let's analyze that. And that is the look of a typical debit spread. Now we can, of course, let's blow this up a little bit, maybe slide it over. There we go. All right. Now here you have a situation where we're actually losing money. T plus 0 to T plus 5. You could see that in 5 days, let me slide that over a little bit. There we go. We're going to lose 28% of our capital just in 5 days of time decay in this situation. So you may not like that. So what would you do? Well, you could bring this closer in right there. Okay. Sell the at the money and buy an in the money option. There you go. And that looks a little bit different, right? Compare the two. We can superimpose, maybe cut it down to 2 lines. And on the second spread, you could see we're actually making money with time decay rather than losing money like on the first one. Now, keep in mind, if this thing does go up to 195, say, you're going to make a lot more money, okay, especially in the interim lines with that further out of the money spread than you are with the at and in the money one. See that? And that's the effect of time decay. We're advancing from T plus 0 on up to expiration going up, whereas on the other trade, we're actually going down towards, let me pull that down a little bit. There we go. Didn't quite make it. Let me see, can I bring that in? No, it's not going down, okay? All right, so that's debit spreads. What's the other one we're looking at? I know. How about covered call writing? Covered call writing. So let's get rid of these. Let's propose buying 100 shares. And let's sell an option, say an at the money 190 to go with that 100. And I'm just proposing these. Okay, let's analyze, see where things are at. Okay. And finally, let's say that we want to maybe explore doing a further out of the money call. So let's come out of here and go out of the money to the 205s. There we go. Compare that. All right. And go flip-flop and go back and forth. There we go. You can see with the further out of the money call in the purple line, if the stock goes up to 200, we're going to make quite a bit more, 6% yield as opposed to just 3% if we did the at-the-money call. So the further out of the money you sell your calls, then the more room you're giving it to breathe on the upside. On the other hand, if you're sitting on this stock and you can't sell it because of tax reasons, one way to help protect yourself is to come deeper in the money. Sell an in-the-money option. Let's analyze that. Okay, there you go. And now we're protected even if it drops in price down to, say, 170, well, yeah, 180 or so. See that? And we can superimpose these and get a much better picture. We're protected on that with that in the money. We'll still even make money if it drops to, say, 180. Okay, of course, if it goes up, our gain is only limited to 1% of our capital there. You see that? Whereas the other ones, we're giving it more room. So again, it's a decision-making tool that enables you to quickly analyze where it is, which strike to select. Now, there's one other thing I want to show you. Let's go back to that credit spread idea. Okay, let's come out here, and let's say that you have an interesting credit spread in mind, and what I want to show you is that we can analyze it using a button where we actually link up our, let me get rid of that. There we go. We're linking up the matrix and the graphic analysis screen somewhat dynamically here. This is just a great way to watch how the position changes as you change dynamically your position over in the matrix here. So if I were to say increase the number of long options I have covering this, and say if I were to bump it up a little bit, you can kind of watch how the position here on the right changes as I raise this thing to 20 rather than just 10, and then I can take it down all the way to 10, right, like that. Now let's say that you wanted to maybe start looking at a butterfly. So let me reduce this to 5, come in here, and I start adding, and I can maybe put a 1 lot there, and as I raise it to cover it, watch how I can have actually a butterfly type thing. And as I move this around on the left, change my trades a little bit, okay, I'm creating a position on the right that we can kind of compare to the way it looks as we, here we go, let me see. As I change it dynamically like that. You see that? Let's bump this up. There we go. And I'm trying to sit here and, here we go. And it's just another way of comparing trades, but you're actually looking at it dynamically change as you change the lot sizes on the left. So again, we're using the link feature here, the link feature right there where I'm pointing my mouse. Finally, I want to show you Trade Finder. This is another great tool to use for decision-making purposes. Here I have the stocks I'm interested in. I'm going to go up to the Trade Finder button. And let's say that I wanted to find the best naked put out of all of these. All right? And I think that perhaps maybe all of these are going to go up a certain level. So I'm going to go to the assets. I'm going to bring these all in. I need to assign a target to each one of these. Now watch this. I can say I feel that all these stocks are going to go up to a certain price. I might think that all of them are going to go up 5% by a certain date. Okay, maybe the expiration of the December options, for example. All right, that's one target I could use. Another target I could customize this to is to say I think they're going to go up between 5 and 10% as of a certain date. And let's go ahead and use that one. I can also use a distribution and shift it around a little bit. And for the more statistically minded, that might be the way to go, is use a bell curve, and I can shift it up bullish or shift it down bearish a certain level, 5, 10% or whatever. Let's go with this 5 to 10% as of December's expiration. All right, I'm going to then click. It's going to assign that target to all of these. All of these stocks now have that particular target in mind. I can go to strategies. I'm going to say, show me the best naked put. All right. Goals. Oh, I don't want to put 100,000. Let's put in $20,000 towards this particular trade. Let's go to filters. Here, I'm just going to go maximum day. Let's go maximum days to sell 45. I know I'll get those December puts then. Okie dokie. All right, when I click go, I'm going to go expected return. Insufficient price information. Okay, let's just proceed without NOAA. Okay. Had to go revisit the NOAA price. Okay, and so here are the potential naked put sales that we could do with $20,000 available in margin. So here we come up with Pioneer first. Okay, and if that target comes to pass, if it does go up 5 to 10%, this one has the highest expected return in terms of dollar amount. See that? And we could analyze that position, and there you go. And you could see that we have our target, 5 to 10% up, shown in the shaded region there. All right, now, let's say that we wanted to do this based on yield. Oh, let's see, where are we? Yeah, let's base it on yield. I'm going to hit go. We'll proceed without NOAA. I could just go back in there and secure that target, but we'll just keep going. And I'm comparing these based upon those that have the highest expected return if our target comes to pass. Okay, and you could see Pioneer comes up at 32% yield, not too bad, based on that $20,000. All right, and we can analyze that one. All right, and let's pick another one. Here, let's go to the second best Pioneer one, analyze. I can then flip-flop, superimpose, and do all of it. Now, we know then that the trades down here, if our target comes to pass, our expected return here at 5,185, come up here, 6,300 for that one. I could go to yield. There we go, 32 for that one, 26 for the other. See that? All right, and I could look at other stocks as well that came up from within my group. Of course, I could choose different strategies. We can go to those that have, you know what, and let me just go, I'm going to go select that NOAA one and see what is the target here. Low price, high price. Here, let's just put in, what's the, oh, I see, it's not coming up. Let me just fix that one here. What's going on? Where's NOAA's matrix? Oh, I need to bring in data here. Let me bring in data. Perfect. It was missing data there for some reason. Okay, so in the trade finder here, we have this one. So let's bring in. It's going to go up to say 20 to 22. All right, let's just run that. Strategies. Let's select short option covered. Let's hit go. These are the best covered calls, assuming that our targets come to pass. All right, and of course, we want to use call options. I had it on puts. Let's run that again. There we go. Now we're getting the covered calls. The other puts weren't going to work on those targets, right? We could have shorted and then sold puts, but the target was bullish, and that's why I came up with nothing. It'll just read your target, come out with the best trades. Expected return, here's a 16%er on covered rights. All right. And what's another strategy? We talked about credit spreads. Tell you what, let's do. Let's run all four of those that we're interested in. Naked puts covered. I'm going to use both options, calls and puts. Let's run all four strategies for all these stocks, and let's just see what it comes up with. What is the best trade out of all these stocks, assuming all of them have the target that we gave them? And it's running through all the strategies you see here. And out of all those strategies, assuming the target comes to pass with $20,000, here you have Activus, ACT. That is the trade that has the highest expected return. Now, We also have another ranking style where we take the expected return divided by the standard deviation. That's called a Sharpe ratio for those of you into money management. And that would be, here's the debit spread there. We could send that trade to the matrix if we wanted. Let's go ahead and do that. And there it is. We can analyze it, and there's our target. And assuming our target comes to pass, this trade would give us the highest expected return relative to the standard deviation of possibilities here. So that looks like a real good trade. Tell you what I'm going to do. Let me finally show you. All right. I'm going to show you a way that we can use the track data security. So I'm just going to put a one lot in here. Let me hit trade. And this is going to actually bring up the order screen for track data. Now, this is a debit spread. I want to buy it for as little as possible, right? Right? Look at this. This is a debit spread. And that debit spread, when you look at both options, here's the bid and ask on both options. Here's the bid and ask on that spread. Okay? And what I'm going to do is actually, and this is how you can work an order. You can come down here, and I'm going to propose that, I want to buy this thing for 90 cents. Do you think I can get into it for 90 cents? Okay? Probably not. Limit debit. Okay? So if I click send, it's now going to start working on this thing. It's working. And you know what? I might say, boy, I'm watching this thing kind of shift around a little bit. It's real-time data flying in. And I can say, you know what I want to do? I want to modify my order, and I'm going to bring it in closer to the fire a little bit, right? So then I click send. Okay? It's got replaced. It's working. All right? And I can drag it. I could then... yeah, let's see. And still, I'm going to modify it, but shift it around a little bit. You see that? I'm going to bring it in again. Let's just go ahead and see. Can I get it for, say, 115? Let's send that. Working. All right. See how we do that? There we go. All right, and watch this. I'm going to try and get this thing filled, right? All right, let's see. I'm going to modify it. It moved to 110 there. I'm going to bump it up to 120. Hit send. Let's see if I can get filled at 120. Or no, it was a little less than that, right? Okay. Anyway, you can keep working, and you can see how all these other trades that we've been working on here over the course of time have been canceled, replaced. We were working orders earlier in the day, and I just want to get this thing off for you here. Let's just see if we can modify this. So I'm between the bid and ask. I'm trying to get the best price I can, right? Let's hit send. Working. See, I've been replacing these, trying to work the order, and I might just sit here for a little longer trying to get a price in between bid and ask. All right, let's modify it. There we go. Let's slide it a little bit over. Let's see if we can get this off here. And it got filled at 131. I had to kind of move in slightly. You see that? Just had to move in slightly. So that's how you use OptionVue to make decisions. Here in the track data, I showed you how to work the order and get it filled. We got it filled for just a little bit, slightly off the midpoint between bid and ask. Not too bad. Okay, thanks so much, folks, for joining us. I hope you found this helpful. Take care. Have a great rest of the day. Bye-bye.